Good morning. Okay, I'm going to be discussing a very important topic in this video, and the topic is this latest development that is going on. That is that Federal Reserve and the government, they are trying to, not even trying, I mean, they are intervening already, trying to save the banks. So what is this implication? I mean, is there going to be any implication regarding all of this? Is stock market going to shoot up now? What do we know so far? So let's discuss all of these things. What do we have over here? Right now, as far as I know, what I've heard and what I have read on the news, that Federal Reserve and government, they have already intervened and they have printed $300 billion in the Fed balance sheet. Now that's actually translates into quantitative easing instead of the quantitative tightening that Fed is doing right now. If you don't know what I'm talking about, let me show you some of the tweets of you guys. One moment. Okay. Okay. I hope you can see the screen. Now, what is she saying? She's saying, did this is Lisa Abramovich. She's saying, did quantitative tightening just end? The Fed balance sheet grew by $300 billion in the past week as the US sought to backstop deposit of the regional banks. So basically, she's raising the question that what is going to happen of the quantitative tightening policy now that Fed was following because of the high inflation that was going on in the United States. Why they have printed $300 billion in the Fed balance sheet? Is that policy over now? Are we going to have more inflation as a result of this printing of the $300 billion? This is the question that she is asking. Let me show you a few more tweets. Okay, this is another person, and he's saying, to those who are claiming 300 billion spike in the Fed balance sheet is not money printing, watch this 60 minutes interview. That's a 60-minute interview of Jerome Powell, and he is quoting him that we print money digitally. We have the ability to create money, and we do that by buying securities. So basically, he's again equating this step to printing of the money. I'm gonna share few more tweets. Okay. Okay, this is the same guy again. And he is basically again saying that the Fed's quantitative tightening program, $300 billion increase in Fed's balance sheet in response to the ongoing banking crisis. This Fed is a sham, pulling wool over everyone's eyes. And basically, he's very angry and he's asking journalists to cover the story. And Now, last but not the least, this is the guy. This is a very funny tweet of a guy who has been calling stock market bottom for the last 2 years, as far as I know. And what is he saying? Okay. So basically, this guy is supposedly some expert, but don't follow this guy. He has been wrong throughout 2 years straight. For the 2 years straight, he has been wrong completely. So basically, he's saying the Russell 1000 growth index has completely undone the last week's decline. FU narratives, belt up. Again, he's saying the problem in the world is that he's quoting somebody, melt up. And this again, another tweet. I have a feeling that there is a major everything short squeeze coming. Basically, this guy has always been calling stock market bottom. Throughout the 2021, he had been calling the stock market bottom, and he again is calling stock market bottom. So there's nothing new about this guy. He's a fundamental analyst, and he doesn't know what is going on. He's just looking at the Excel spreadsheets, and every time he's trying to catch up, falling knife. Every time he's trying to say, "Oh, stock market is going to go up." Obviously, in the long run, over the period of 100 years, stock market has gone up. So anybody who says stock market will go up is not a genius. That's a that's a pretty uh, okay thing to say. It will go up because human beings collectively we grow together. We grow as a nation. We grow as people. Our economy grows. Our technology grows. So stock market obviously will grow. But what about the timing? Calling the stock market bottom every time for the last 2 years when the stock market when the Nasdaq crashed from 17,000 to 10,000 almost. Are you guys are you serious? You're calling stock market bottom for the last 2 years, and you are an expert, and again you're calling for the melt up. Here we go. We are going to go up. Bears are dead. What is this? So now in this video, basically I'm going to be addressing the question: are we going to go up now? Is the stock market bottom already in? Is the Fed intervention and the government intervention finally going to catch the bear off guard? Are we going to do new all-time high? This is the question that I'm going to be addressing in this video. Okay, for that, obviously, I need to pull up the charts. I cannot talk my way through the analysis by just talking. I need to show you something. So I'm going to show you chart that we have, and I'm going to do a little bit of a longer video compared to the usual. So where is my chart? Okay, here it is. Okay, I'm going to delete everything, and I'm going to start from the very beginning. Okay, so this is the Nasdaq daily chart, and we have been going down consistently. See, from the January 2021, January 2022, we have been in a decline. How we are declining? Lower low, lower high. Lower low, lower high. Lower low, lower high. So, can we get another lower low, or are we going to make a higher high? This is the question. So, let's find out. Now, if you look at the chart, we can clearly see a decline in WXY wave structure. So I think this hole was W. I hope you can see the yellow. Otherwise, I will make the color in red. One moment. Okay. This hole was W. This thing is Y. And now we are going to decline in Z. Right? Sorry. Why do I always make this mistake? This whole thing was W. This is the X. And now we are going to decline in Y. Right? So we need to find out the targets for the lower Y. So it's not very difficult. I'll just use the formula. Now, assuming this is the end of W and this was the X, this whole thing was X, then here you have it. We hit the 618 Fibonacci extension in the Y, and that is it. We have ended WXY with a shortened Y wave. But if we make W end here, then it means we haven't reached the target yet. Correct? Now, one more thing. If we do Fibonacci retracement extension of this X, then we haven't hit our target as yet. What is the target? 10,370. We haven't hit this as yet. But if we assume that this was the X, then we have hit our 1.270 target over here. Can you see it? And now we have fulfilled the minimum requirement for the WXY, and we can start to go and make higher high or make a complex WXY, WXY, and then WXY like this. For example, we will decline in a way WXY, WXY, and then WXY like this. A complex correction. Nested WXY. Right? So this is the question. So are we going to continue going down from here, or are we going to go up? If you look at our indicators, then clearly this looks like a corrective wave up to me, and the cycle has one more down, right? And also that is continuing from the last element. That is, I'm expecting something like this minimum. Even if we are not going to go down like this, I'm expecting something like this, corrective. Also, if we draw trend line connecting these two tops, right? Then we have broken this trend line, but we haven't backtested as yet. Also, if you go to the weekly chart of NASDAQ, then very true, it is residing on weekly moving average 200. But what do we have over here? We have hidden bearish divergence. And look at this hidden bearish divergence. That is lower low on price and higher high on the indicator. Higher high on the indicator. So what the thesis is going to be? Are we going to do a melt up with the hidden bearish divergence? So much prominent in the weekly time frame? I don't think so, because we in the weekly time frame we have this W, X, and then we need Y. You understand my point? The hidden based divergence is actually depicting the X wave that I am talking about, the whole X wave, and that's why there is a hidden based divergence. So we need a move down to end this hidden bearish divergence. So also, one more thing I want to tell you. Now this is very important. Nobody is going to tell you this thing. If we do Fibonacci time retracement of this decline from here to this top, then we have Fibonacci equal leg coming to around April 3rd or March 31st. I will write this here. March 31st or April 1st. Sorry, April 3rd. This line. So with everything in place, with the hidden bearish divergence on weekly, and with the with the broken trend line, but not yet tested, with the cycle for the down time still not being done, because the down cycle will continue to be in force until March 31 and April 3 at least, right? And also with my algo lines down at the bottom here, this green line and this gray line, we expect a decline to this level, to touch this gray line, by March 31 and April 3rd. Now after this 31, after March 31, we can expect it to go up one more time before declining. You understand what I'm trying to say over here? Why we will bounce on March 31 or April 3rd? Because the down cycle would end. So it would give us a temporary bound and doing a complex WXY correction here. I mean, like this. WXY, and then WXY. We will then go down in WXY also. But let's not get far ahead of ourselves. Let's discuss the things bit by bit. So, like I was saying, on March 31, we can expect to do like this before forming a bottom, and then we can trade the long air, and then we can expect a decline later on. The same thing we can expect in ES. Can you see the ES? We have not completed the equal leg, which is not done until 31st March. The same structure for the time extension. Similarly, we will be retesting the broken trend line, the yellow trend line that you see. And also, we will be testing the gray line of the algo. Can you see this? It has not been touched as yet. So until this gray line is not touched, we cannot safely say that the bottom is in. You understand? And after this, we can get a bounce, and then we will go down again. So whoever is buying stock market shares right now, is going to be in for a surprise, because we will not form bottom until March 31 is not in. Only after March 31 we can expect to form bottom. So whatever the Fed is doing, they can do whatever they want. The plan that we have, it must complete. This is the minimum requirement for the plan. And this is also the biggest proof that don't bother and waste your time looking at the news, looking at the tweets, looking at people who are always calling the bottom. There are two types of people in the world. One who are always calling the bottom, and the other who are always calling the top. So you don't want to be any one of the two. You want to be a third one. So I did a very detailed analysis about everything, and I hope you understand. If you want me to talk about how Silicon Valley Bank got itself bankrupted, and not because of the fraud, but because of their own stupidity. Why? Because they had bonds with them, and because the inflation was increasing, so that's why the interest rate was also increasing and the bond yields were increasing. But when the interest rate goes up, the price of the bond, it goes down. And it's not linear in any way, because interest rates, when they go up by 1%, the price of the bond, it declines by more than 10%. You understand? So SVB, the Silicon Valley Bank, it had many of the tech companies with itself as its client. So SVB, Silicon Valley Bank, had to sell the bonds at the loss. And when it got the losses were getting reflected on the financial statements, the story was picked up by the investors, and the government had and you know the clients, they got to know, and they rushed to the bank to get the funds, out, because FDIC has only insured the deposits up to 20 I think $250,000, not more than that. But these tech companies had millions of and even billions of dollars with Silicon Valley Bank. So what happened next? The government had to intervene. Why? Because the Silicon Valley Bank contained the startups which were made by the rich people, which were these startups were being run by the private equity guys, and the guys who were, the donors and the, very influential in the Washington. So the government had to intervene to save the rich people. So they formed BTFP, a new emergency bank term funding program, over the weekend on Sunday, so that no such bank run happens and there is no loss of confidence to the depositor. That is, they will among themselves guarantee each other, and they will, for example, next time a bank like Silicon Valley Bank wouldn't have to sell the bonds at a loss. It can put the bonds as a collateral and get the funding from the Federal Reserve. And now most of these banks are utilizing this emergency BTFP program to save themselves. And now that is why everybody is calling the bottom for the stock market. So is the bottom in? Just because BTFP has been formulated by the Federal Reserve. Now, are we going to go up? Are we going to go up even when the minimum cycle for the bounce is not going to be ending until the March 31 or the April 3rd? No, we are not going to go up. We have to wait till March 31 or the April 3rd before expecting a bounce. And even that bounce will fail. Why? Because that is a plan and everything is planned. Thank you. Have a good day.